All right. Hello, everybody. Welcome back to the channel. We are live. Should be good to go. We're starting off earnings, folks. Netflix is in 15 minutes. It might be at like 4:05, probably 4:10 to be honest. So it might take a little bit until we get their numbers. But I hope everyone's excited. We've been waiting for this one for a while now. After Netflix, next week we have Tesla. I think we have Facebook and Google next week as well. Then Microsoft, Amazon, Apple, all the big guys are starting. So over the next few weeks, it is going to get pretty crazy. We'll be listening to the entire earnings call as well. So starting at, I think, 5 p.m. usually Eastern Standard Time, 2 p.m. Pacific, we will pull up the earnings call, and then we will listen to what is happening. Hello. Thank you all for being here today. Now, before we get into the Netflix call, which is going to happen in about 20 minutes, or the earnings, and then the call in about an hour, let's talk about the markets. Markets are very interesting right now. Palantir 2113, Tesla 150, somehow maintaining that 150 level. It was struggling at 148 for a little bit early in the day. Let me know if you bought Tesla today. Coinbase 217, Robinhood 1709, CleanSpark 1633. CleanSpark up a nice 9.45% on the day, and then Nvidia at 848. The S&P 500 is at 500, basically flat. We got jobs data this morning that indicated that we have less unemployment than we expected, which is no surprise because the labor market is tight. But we also had one of the Fed presidents today talk in a speech. Why do these random Fed presidents keep giving these random speeches at these random conferences? I have no idea. I don't know. I just don't know why they're talking all the time. But what he said, it was President Bostic. He said he does not expect rate cuts until the earliest end of the year. And he pretty much said the same stuff Jay Powell said, which is that the current data is not the best. We're looking forward to getting new data. And until we get that new data, we're not going to be able to make any conclusive decisions. He went so far as by saying he doesn't expect rate cuts until the end of the year, which means June, July, I think it's off the table. May is definitely off the table. May is just not happening. June, I would severely doubt it's happening. July, some people are saying it's possible. I don't think it's happening in July, which means September really is the first chance for us to get a rate cut. So Q1 and Q2 earnings, which will end by August, are going to literally determine how well the economy can continue holding up, or the stock market can continue holding up, because rate cuts are not going to be a catalyst for us to be able to get there. So going to be interesting to see how that plays out. Why is the market basically flat? We had a little bit of a downside, 498 on the S&P. Then we went back up to 501. Robinhood below 17. Now it's at 1706. It was at 1730 at one point. Crypto doing okay, up 2% of the day. That's why the crypto stocks are all right. And then big tech is relatively flat or green for the day. So nothing too crazy to the upside or the downside. Netflix earnings in the next 11 minutes, I think, are going to determine a lot about the trajectory of how big tech is going to perform. I know Netflix is a different business than a lot of these companies, but one thing to remember, Netflix needs subscribers. What we're looking for in the context of Netflix is more subscribers and more revenue. The reason I say Netflix does impact some of the other companies is because it's not the most intense example, but a company like Netflix has to spend to get those subscribers. The money they're spending is on a Facebook, is on a Google, right? They're using I believe they use AWS for all of their cloud and infrastructure. If they don't have people using their platform, aka watching Netflix, so in the context of Netflix's metrics, it's daily watched hours. If that's not going up, then the bill they're spending on AWS is not going up, right? Because it's based on consumption. So all of these companies, from the advertising perspective, from the cloud infrastructure perspective, are intertwined. And Netflix is one of the core big companies that is a big player that integrates itself into all the other ecosystems of big tech. So that's why I do think Netflix does matter. Now, if Netflix tanks, does that mean that Meta is going to tank, or that Google's going to tank, or that Amazon's going to tank? No, but especially because Netflix is already up 30% year to date. But I do think it will be somewhat of an indication, if they miss severely on their numbers, that maybe the other big tech players didn't have the best quarters as well. Because if a company like Netflix is not growing subscribers and spending a ton of money on advertising or cloud, then you can't expect a ton of other companies to be spending those same amounts of resources on a company like Amazon, Google, or Meta. Netflix right now, 611, market cap 264 billion, 4.3 million shares have been traded so far throughout the day. One thing on Netflix, let me pull up their preview numbers for earnings. Netflix, we are expecting today We are expecting EPS of 452 and revenue of 9.2 billion, and we're expecting 4 million new subscribers. So we're expecting $4.50 a share, 9.2 billion, and then 4 million subs extra. Last quarter they did 5 million subs. If we can do that, then hopefully Netflix will do one. Palantir is 21.13. Palantir was below 21 for like an hour-ish, and then it rebounded pretty easily. So nice to see Palantir there. Could it fall back below 21? Yes, because it's barely above 21. But we'll see. I mean, it was nice to see the dip was bought pretty aggressively. I mean, it was at 2070 at one point and then swooped right back up. So, and it's not just Palantir. It's pretty much every company had a nice V-shaped recovery today. But in general, I still do think that, we're either going to be flat or head to the downside, given Jerome Powell made it obvious, and then Bostic today made it obvious that we're not going to get rate cuts anytime soon. One more headline, and then I want to talk about the Tesla downgrade that happened today, because I thought the analyst that went on CNBC to talk about it actually had a really decent argument. The U.S. is pushing for a deal. This just came out by the Wall Street Journal that presses Israel to accept Palestinian statehood in exchange for diplomatic recognition by Saudi Arabia. Now, if you've done any research on this conflict or kept up with it kind of mildly over the past 7 months, before the Hamas attack on October 7th, Saudi Arabia was close to recognizing diplomatically Israel. What does that mean? That means they're going to recognize them as a state. They're going to have diplomatic relations. They're actually going to be able to do trade with them, all the stuff that comes with recognizing a country. And one of the reasons Hamas said they attacked was to stop that from happening. And as soon as they did that, Israel retaliated, obviously. And then Saudi Arabia basically said, we can't recognize you. This is a long shot. It is described by the Biden administration as like it's probably not going to happen. And I don't think it's going to happen. The Palestinians don't like Biden. The Israelis don't like Biden. The Saudi Arabians definitely like the king there, Prince MBS. He's not a fan of Biden. No one likes Biden. So I don't think Biden's getting this done. I definitely don't think Biden's going to shake hands with any of these people. It's going to be his Secretary of States in that nature. But this is something to keep in mind for investors, because if on the slight chance this gets done and Palestine is recognized as a state by Israel and Saudi Arabia recognizes the state of Israel, I think we're going to have a lot less instability in the Middle East. We will have more peace, which would be great for the stock market. Is that going to happen? No, that's not going to happen. I don't think that's going to happen. But one thing I wanted to inform you guys, given the Biden administration is trying to do that right now today, I think it's another thing where they're just trying to get some last minute votes, because I mean, there's just no way that's going to get done. If that does get done, I'll give it up to Biden. That's a hell of a deal. It's just going to be hard to see if that can play through. Let's talk a little bit about Tesla. So the person who downgraded Tesla today to $123, he went on CNBC. I think he actually had some decent points here. So let's listen to what he had to say from Deutsche Bank. He's actually a very long-term bull on the company. Here's his bear case for what's going on right now in the world of Tesla.
Yeah, thanks so much for having me. So look, we've actually been at the forefront of warning investors about meaningful near-term downside risk. Basically, Tesla is under tremendous pressure. There's a lot of pressure on the demand side for their vehicles, pricing pressure, earnings pressure, free cash flow. So if anything, we've had some of the lowest estimates in the near term, both for 2024 and 2025. But we've been okay with it as long as it was perceived as being temporary. And it would have been temporary because the Model 2 was supposed to come next year and re-accelerate things, re-accelerate volume, margin, earnings, and free cash flow. I believe long-term investors on board as well. They know how bad things are now, but they expected things to turn around. Now that Model 2 is likely being pushed out, potentially even canceled, you do not have this on the horizon anymore. And so now earnings are under pressure, free cash flow is under pressure. There's no turning point to this. Hence, this is thesis changing, and this is why we're downgrading the stock.
So we're no longer talking about cycles or valleys between innovations. You think this is more structural?
This is essentially a function of an aging product lineup. So the core product lineup of Tesla is old. It's facing increasing competition. It's also facing larger headwinds around EV demand, especially in the US. And as a result, the volumes at Tesla are now less than flat, right? Q1 was already down. Q2 could also be down year over year. That's despite massive price cuts over the last 18 months or so. And so, yes, it is structural. It is not cyclical. It could have been solved by having essentially a new product at a low price point.
But that new product's not happening, and that's why the street is mad. Now, in the context of what Deutsche Bank is saying, Dan Ives, who is a long-term Tesla bull, he is not that different from what Deutsche Bank is saying. So right here, Dan Ives on Tesla, and then we'll get into a little preview on Netflix. Dan Ives said in an interview, if they don't pursue the Model 2 and go straight to robo-taxis, it's like Apple saying they are stopping at the iPhone 15 and to now please wait until the iPhone 25 comes out, meaning they wouldn't release 10 generations of iPhones. Robotaxi can't hit scale till 2030 at the earliest. That's what Dan Ives is saying. And if they don't pursue the M2, being a Tesla investor will be like standing on the edge of a cliff and looking down below. So Dan Ives with a very sort of definitive argument around Tesla saying, look, if you're an investor in Tesla and on the next earnings call, they don't clarify what's happening with the M2, you're going to be screwed. And that is his argument. I think to an extent he is correct, but I also think the street's not understanding the long-term thesis around robo-taxis. Brad Gerstner of Altimeter Capital, he just went on his podcast and he said that the reason Tesla is excited about robo-taxis is because they obviously know something about FSD that the rest of the world doesn't. Does that mean the street deserves to cut these price targets? Technically, yes, from a short-term perspective. From a long-term perspective, I think they're making the same mistake they made in 2019 by underestimating the scale of Tesla's data advantage, but no one really cares about that in the short term, right? Which is why the stock can struggle over the coming at least 6 months. Netflix, we got Netflix earnings in about 3 minutes. Let me play this clip right here, why Netflix could be a beneficiary of AI. And then we got the market close and earnings in about 5 minutes. Here we go.
Crockett, senior internet media analyst at Rosenblatt Securities. He's sticking with a neutral rating on the stock ahead of its results. Barton, it's always great to see you. You're a bit more cautious going into the support, but you're not alone. I read the reports from Deutsche Bank, Goldman, among others. Your price target, 554, which is below where the stock is trading. Tell us why. Tell us the number one reason you're a little bit more cautious.
Well, I think Netflix's stock has a strong history of really moving in tandem with subscriber growth. And they've had a tremendous lift in 2023 from the paid sharing crackdown. They added nearly 30 million subscribers in 2023. And that was on, 100 million people globally, 30 million in the US being impacted by paid sharing. Many of them, I think, have already signed up if they were going to. And so I think the impact of that fades. And I think you're probably looking at a 2024 where there's much less subscriber growth than there was last year. And history would tell us that that's a tough setup for Netflix's stock. And so that's number one. And, I think we'll start to get a sense of that here with the March quarter earnings, but really the story will be told in the June, September, December quarter when the paid sharing comps really kick in.
Is it competition and also?
All right, so his argument is a little bit more bearish on Netflix because the competition is getting a little higher and subscriber growth is going to be tougher to achieve. I think that's a fair argument. I am bullish. I just put a poll in the chat. Let's get some votes there. What do you think right now? We're at 57-43, so basically 60-40 on Netflix post earnings, moons versus tanks. Right now, 60% of you guys feel like it will go up. I'm going to go bullish. I think Netflix has a shot to just show they're the only really profitable streaming company that exists. And as a result of that, the street's going to have kind of nothing. The street's not really going to be able to buy HBO, Paramount, or Disney. They're going to have to pile more money into Netflix. Now, granted, I say that with the caveat that Netflix is already up a lot this year, 27%. They added, 30, 40 billion in market cap. So if it falls, even on a good earnings, I think that's normal. That's reasonable. But, oh, wow. Did you guys see that? Whoa, guys, it's up 5%. Oh, my God. It's at 640. Did you guys see that? It went from 640 to 616. Oh, I think earnings are going to be good. The market literally closed 17 seconds ago. It's not just me, right? You guys saw that? You guys saw it. Now after hours, it's already up 3%. What the fuck is going on, dude? The earnings are not out yet. Now it's down. Now it's down 3%. Oh my God, now it's down 5%. What the fuck is going on? The market's closed, guys. Dude, what is going on? There is some manipulation happening. It went up to 640. It was up 7% at 4 p.m. The earnings aren't even out, by the way. There's no numbers. Maybe the Bloomberg terminal got them, but usually they get them at 4:01. They don't literally get them at freaking 4 p.m. Like, that's insane. Hold on. Are the numbers out and I'm missing it? There's no way. It takes like 5 minutes. Yeah, it's not. Wait, is it out? Oh my God, it's out. Yo, they never put it out that quick. Okay, it's out. It's out. They're down. They're flat right now. How did it cut? Wow. Do you guys remember last earnings season? It took like 10 minutes every time for a company to release earnings. Here it is. It's out April 18th. We did not have to wait 1 second on this. Here we go. All right. Netflix earnings. We're off to a good start in 2024. Compared to Q1, our revenue was up 15%. Our operating income grew by 54%, and our operating margin rose by 7 percentage points to 28%. In full year 2024, we forecast revenue growth of 13 to 15. That's good. That's not bad. Where's the actual numbers? Okay, Q1, they did 9.3 billion. They did 9.3 billion. The street was looking, hold on. Let me get what the street was looking for. The street was looking, let me just get this in real time so I definitely have the right numbers. The street was looking for Netflix to do 9.2. So they beat on revenue. Okay, they beat on revenue. Year-over-year growth, 14%. Memberships on paid. Oh, shit. Guys, they added 9 million subs. Holy crap. They added 9 million subs. Wait, what was the street expecting? I think the street was, I think the street was expecting 9 million. No, the street was expecting 4 million. Where's the stock? Yeah, there you go. There you go. Stock's up. Stock's up. I think it holds. I think it holds. The street was expecting 4 million subs. 9 million is a 5 million beat. That's big, big, big. That's big. I'm pretty sure the street was expecting 4 million. That's big. That last quarter they beat by 5 million again. Look, last quarter they had 13 million subs. The street was expecting 8 million. They beat by 5 million. This quarter the street was expecting 4 million. They brought in 9 million. They beat by 5 million. That's huge. That's fucking huge, dude. That's not easy to do. 9.3 million. Wow. For those that are just joining, revenue is a beat slightly. Subscribers are a big beat. And year-over-year growth on revenue is 14%. And look at the growth on the year-over-year on revenue. For the past 4 quarters, 3% growth, 2% growth, 7% growth, 12% growth. They are back to growing at almost 15%. And in Q4 or Q2, they're expecting 16% year-over-year growth. 15.9. This is not bad at all. Where's the stock? Stock's at 620. Okay, so stock's like not selling off. At least it's flat. I thought that, I mean, and again, it's up 27% year to date, right? So maybe the stock is going to struggle to keep going higher, but definitely not a bad earnings for Netflix, dude. These are good numbers. These are good numbers. Q1 revenue grew by 15%. Operating income 2.6 billion versus 1.7 billion in Q1 2023. They added they basically added $1 billion of operating income. That is an absolutely incredible. That's an increase of 54%. And their margins are up 7 percentage points versus Q1 last year. That's also really good. They're becoming more efficient. They're figuring out how to not spend as much on content and how to cut costs around the corners to be able to get those operating margins to go higher. TSM was in the morning, guys. TSM was good. It was down 5% because the stock's up 40% year to date, but TSM earnings were also pretty fantastic. There was no big issues there. As we noted in our last letter, our 2 priorities in ads are to scale our member base and to build out our capabilities for advertisers. We made progress on both fronts in Q1. Our ads membership grew 65% quarter over quarter, with over 40% of all signups in our ads coming from our ads plan for advertisers. We continue to focus on measurement solutions, blah, 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 and different brand awareness. This is good. This is not bad. These are really good numbers, in my opinion. These are really good numbers. Where is Netflix right now? So Netflix after hours is down 1%. I think it's down because, again, the stock is up a lot this year, but these numbers, I don't see anything so far. Even the guidance looks incredible, where it looks like it's going to be pretty good. Let's go to CNBC and see what they're saying on Netflix right now. They just got the numbers as well. Let's see what they're saying. Here we go. Let's go to them and then we'll keep going. Here we go.
And net ads coming in at 9.33 million net ads. That smashes expectations of 4.5 million. Still digging through the numbers here, Morgan, but it looks like shares are up 2% so far in this.
Okay, Steve Kovac, we'll be back to you for
Thanks.
more as you dig through this report. In the meantime, let's bring in Vital Knowledge founder Adam Crisafulli and Evercore ISI head of internet research, Mark Mahaney. Mark, I'm going to go to you first. You've been bullish on Netflix for a while. The fact that we're seeing 9.33 million in net ads, which is more than double what the street had been expecting. Your thoughts?
Well, this stock is always going to trade off subs. I know the company would like not to hear that, but it is. And these subs the sub performance was really impressive. So, we're going to look for the guide. We're going to look for commentary on the call as to what's the source of the upside. Is it the core business? Is it paid sharing? Or is it the ads, new ads business? And my guess, our strong guess is it's all three. You also have the pricing actions that are taking place. I mean, they're accelerating sub ads when they're taking up pricing. Very few businesses, consumer businesses, can do that. So it's kind of hard not to be bullish on this. Now, it's had a big run. Valuation is getting pretty full on this, but I think the stock continues to rise. If you can put up sub numbers like this and expand margins, that's good. You want to stick with a fundamental winner like that.
Yeah, and of course, we're seeing shares move higher as investors digest this report. Adam, I mean, this is sort of the unofficial kickoff of tech earnings season when we get this report. What does it signal here? How does it set the stage, especially on a day where, once again, we saw the market
in overtime on what we've been talking about just in the numbers is a very strong report. At the same time, with the rates, interest rates looking to stay higher for longer based on the Fed's recent commentary, growth stocks are facing quite a bit of pressure to go higher from here, aren't they?
Yeah, 100%. So you have the macro environment working against the sector. And now, if earnings aren't perfect, that's just going to be an added headwind. And I think that's why, tech investors in particular, and tech's one of the few groups where you still do have a lot of technical imbalances in terms of positioning and sentiment and valuation being offside. So if you now have the macro plus the micro starting to go against you, that's the one area of the market where there's still a fair degree of vulnerability.
All right, Netflix is down 5% right now. The reason it's down, again, is kind of what he just said, which is something we got to think about as investors. If Netflix can't stay up on these numbers, not the best start to earnings season. Not the best start, guys. Netflix, for those that are just joining, they beat on revenue. They beat on subs by 5 million, and they beat on EPS. And they increased their operating margins. So for them to not have a stock that's higher right now, granted, it was fully valued. It was up 26% year to date, but these are not numbers that signal something's broken. At least that's not what I'm getting from these numbers right now. So this is actually very interesting to see kind of how this is playing out. Tom Brady says it's the macro has everyone hawkish. Yeah, I agree. I mean, I think if you're a Netflix bull, I think Netflix bulls will definitely buy this dip because the business performing the way it's performing probably doesn't warrant this dramatic of a drop. Now, 5% is 5%. It's not that crazy, but the stock was up at one point at 630. So the stock was up almost 3%. Once the numbers came out, it's just, I guess, as the numbers have been digested, flipped more to the bear side. Israel and Iran potential war. Yeah, look, there's a lot of geopolitical and macro reasons for why stocks will sell off like a Netflix. It's just these numbers are good. These numbers, I would say if they're bad numbers, I don't have a position in Netflix, so I'm unbiased here. I don't care that much, but I would say if the numbers are bad from what I'm looking at. Let's go back to the doc they put out. It doesn't seem like maybe we're missing something. Maybe we're missing something more dramatic here, but I don't see something that's that bad. Q2, we forecast revenue growth of 16%. This equates to 21% growth. We expect paid net additions to be lower in Q2. That's fine. I mean, that's not a big deal. It's Q2. That happens every single year. For the full year 2024, we expect healthy revenue growth of 13 to 15%. That's good, dude. For a company of Netflix's size to compound 15%, that's not easy. That is not easy at all to be able to do. So the fact that they're ready to do that, or they're trying to do that, I mean, that's good to me. That's not crazy. Q2 full year revenue, 9 point. Yeah. Oh, I see what you're saying on Marcel. They're talking about Q2. Yeah, Q2, they're expecting 9.5 billion. 9.5 billion. I don't know, dude. These are not the worst numbers in my opinion. Let me see what else we have here. Paid membership reporting. Okay, let's read through this and see what they're saying here. Let me just clear up some tabs, guys, because I have a little bit too much going on here. Okay, let's get rid of this. Okay, here we go. Where's StreamYard? All right, here we go. Wait, real quick, before we read this, let's look at some of the other big tech stocks and their reaction to Netflix, and then we'll go back to the thing. We'll be listening to the call at 5 p.m. So, Mag 7, Microsoft's slightly down, Meta slightly down, Google slightly down, Amazon slightly down, Nvidia slightly down, Tesla is 149.89 after hours, they're down, and Apple is green. So, 6 out of the big 7 are red after hours, even if it's slightly because of Netflix. Netflix right now currently is still down 3.87%. So not down as much as it was before, but it still is red after hours. We got to try to figure out why the street is selling it off. And if you guys read anything that lets me know, then put it in the chat. Why the street is selling it off. Okay, as we noticed in previous letters, we focused on revenue and operating margin as our primary financial metrics and engagement, i.e. time spent, as our best proxy for customer satisfaction. In our early days when we had little revenue or profit, membership growth was a strong indicator of our future potential. But, it looks like they're changing a little bit of how they report metrics. Now we're generating very substantial profit and free cash flow. We are also developing new revenue streams like advertising and our extra member feature. So memberships are just one component of our growth. In addition, we've evolved our pricing and plans from a single and multiple tier with different price points depending on the country. Each incremental paid membership has a very different business impact. It's why we stopped providing quarterly paid membership guidance in 2023. And starting next year on our Q1 2025 earnings, we will stop reporting quarterly membership numbers. I think that's why they're selling it off, guys. That's why they're selling it off. The reason, that's got to be the reason, dude. This line is the reason. The reason they're selling it off is because the street thinks, oh my God, Netflix is not going to grow as much anymore because they're not going to report their quarterly paid numbers or their quarterly members in general. Which is kind of weird, dude, for a business that literally, the business model is very simple. People subscribe, they make money. As an investor in Netflix, if I don't know how many new people subscribe, it's a little, I'm kind of curious. Like that's, as a public shareholder, I would like to know that. They said we would continue to provide a breakout of revenue by region each quarter and the FX impact to complement our financials. For guidance, we'll add annual revenue guidance on top of what we already provide today. This is weird, dude. This is weird. This is why it's selling off. It's down 3% on this news. This is actually a reason why I would sell the stock. I'm not going to lie. If I had a heavy, I don't know if I would, if I had a position in Netflix that was 500 to 530 as my average, and I can get out right now at 593, I might not be the most hesitant to get out, because to not have these numbers anymore, it's not about them not reporting the numbers. It's about why they're making this decision. Let's say Netflix was adding 17 million members a quarter. I'm pretty sure they would have no problem telling you how many members they're adding, right? When a company decides to stop showing something, it's like Palantir with the net dollar retention, right? I love Palantir, but the reason they stopped showing that number for the past 4 quarters is because that shit kept going down and down and down. Last quarter, they finally showed it because when it went up 1% quarter over quarter. But when a company stops reporting, it's because that metric is likely not a good metric anymore for that company. And you could believe them that their business is diversified enough to have other metrics, but it's not that diversified, dude. The majority of the revenue is paid membership. Yeah, there's a little advertising and some games and stuff, but it's memberships, right? Decreasing transparency. That's correct, Isaiah. That's exactly what they're doing. So the numbers were phenomenal this quarter. I think most of us who are bullish were correct that the numbers were going to be good, and like the numbers were good. What we didn't expect is for them to be like, yeah, we're not going to continue to have the best numbers, which is why we're going to stop providing these quarterly paid membership guidance numbers. That's weird, dude. Like that's really weird. Now, Spotify has something similar where they don't give guidance, but they do provide the number of monthly active users and the paid membership additions. I don't even understand how you can value Netflix without knowing how many subscribers they're getting a quarter. And wouldn't people figure it out anyway? Like if they said, hey, we did $10 billion of revenue or $15 billion of revenue, wouldn't you just divide that by the price? And you would take out a little bit of here and there for advertising and then come to a conclusion. Like people can figure it out. At least the smartest analysts, I'm pretty sure, could figure it out. Probably an FX reason. I don't think it's an F. Oh, that's what. Oh, Young. No, that's a good point. That's a great point by Young. So what Young is saying in the chat. That's a really good point. It's an FX reason, not because of because there's some issues with showing different currencies, but rather they're getting so many foreign subscribers. So Netflix is determined based on ARPU, right? Average revenue per user. They're getting a lot of APUs in India. And the problem with APUs is that there's no ARPU for an APU, because an APU with no disposable income is paying like $2 a month. They're a subscriber. They are a paid subscriber, but they're not a paid subscriber generating significant revenue for the company. Maybe that's why, because they're getting such an international audience, they don't want to show these subscriber numbers. Maybe that's the reason. Maybe that's the reason. Okay, engagement. Strong engagement starts with a strong slate. In Q1, we had a wide variety of high-performing titles across multiple genres. For series, these included Griselda. I heard of that one. I heard that's good. Three Body Problem. I heard this is really good as well. I haven't watched it, but I saw some clips. Avatar, Love is Blind. That shit is stupid. I don't know why anyone watches that, but people watch it. American Nightmare, Dave Chappelle, and then a bunch of other stuff. Okay, so they're basically saying, hey, we're the only ones that can really make content. For the third time in the last 4 years, our movies made us the most nominated studio at the Oscars. I don't care about the Oscars, but in the world of Hollywood, the Oscars still matters. With 98.5 million views, it's now our second most popular non-English movie of all time. They're talking about Society of the Snow. Almost 270 million households across 190 countries now subscribe to Netflix, with more than 2 people per household on average. We have an audience of over 500 million people. No entertainment company has ever programmed at this scale with this ambition before. To satisfy such a large audience, we need many great stories that appeals to a lot of different tastes. Today, our share of TV viewing is less than 10% in every country. So we have plenty of room to add value. Basically saying the market is big. We're very excited for our much anticipated live boxing event between Jake Paul and Mike Tyson. Yeah, this is the weirdest thing in the world. I don't know if anyone saw it, but Jake Paul and Mike Tyson are fighting live on Netflix. It's going to be weird, but yeah, they're basically saying, hey, we have a ton of engagement. We have a ton of engagement. So share of US TV streaming, 38% in March. They had 8% out of that 38%. This is from Nielsen. That makes sense. It makes sense. Not bad. We'll go through more of this stuff. Let's go back to CNBC, see what they're saying on this one, and then we'll keep going. We'll keep going from there. I think the call is in about 40 minutes, so we'll listen to the call as well in 40 minutes.
The coming weeks and months.
Mark, I just want to go back to operating margins for a second. It looks like Q1, 28%. What they're forecasting for Q2 is 26.6%. And for full year, as John mentioned, 25%. So even though we saw this big jump, it looks like a 7 percentage point jump in operating margin for Q1. That's going to erode a little bit here as the year goes on. How much does that matter?
I don't think that matters as much in terms of the aftermarket sell-off as the kind of the confirmed outlook for deceleration in the back half of the year. You're going to get accelerating revenue growth from Q1 to Q2, and then the multiple's fine then. But when the revenue growth starts to decelerate, which is kind of what's implied in their full year guidance, then all of a sudden the multiple doesn't go higher, it holds, or it starts to derate. And the question is at what rate, how quickly it can derate. That's probably what's behind the stock reaction right now in the aftermarket.
All right, with the stock hovering around down 4.5% to 5%, let's go back to Steve Kovac for more on the subscriber numbers. Steve?
Hey there, John. Yeah, just an interesting thing here. Netflix saying starting with its Q1 2025 earnings, that's a year from now, they are going to stop reporting their quarterly membership numbers and average revenue per membership. Those are two very important metrics, like we were just talking a few minutes ago, blowing away subscriber expectations here, but pretty soon or about a year from now, we're not going to be able to look at those numbers. They're going to stick to revenue, kind of like Apple has done with its gadget reporting segments, just talk about complete revenue instead of unit sales. So that is going to start again in Q1 of 25, John.
Steve, thanks. Mark Mahaney, back to you real quick on that. How much does that matter?
Well, I don't know any investor who would like that. We like more disclosure rather than less. I think it's kind of a chumpy move. They should continue to disclose subs and ARPU, but it's their prerogative. And they've been saying for a while they're really focused much more on revenue. I actually think this sub base has still got a lot of growth ahead of it. I still think they can get to this 500 million, sub number, this sub goal within 5 to 10 years. So I think it's a good thing to disclose that. And it's always a negative when companies take a metric that a stock trades off of and they tell you they're going to stop disclosing it. That's always a negative. I get the trading reaction to that.
Yeah, we like more numbers, not less. Mark Mahaney, Adam Crisafulli, thanks to you both.
Thanks, John.
Now let's bring in senior market commentator Mike Santoli for more on Netflix and the bigger picture for growth stocks.
All right, we'll get back to that in a second. Yeah, it's kind of sus, right? Do you guys think it's weird? Do you guys think it's weird? It's kind of weird that they're not disclosing those numbers. It feels a bit weird. Now, I know Apple doesn't literally disclose their iPhone unit growth and things of that nature, but Apple's worth a couple $1 trillion. Netflix is not at Apple's level to the point where they can be so big they don't have to worry about that anymore. Like, you know what I'm saying? It's kind of like it's a little too arrogant at this point. Like, I know you're the biggest streamer, but you're still a streamer, my guy. You're not like a multi-trillion-dollar company like Apple. That is weird, dude. That is very, very weird. Very weird. It's super sus, right? Who owns Netflix in the chat? Put in the chat. Do you own Netflix? And what average do you own Netflix at? Or how long have you owned Netflix? Put in the chat. Netflix right now, down 2%. It's recovering a bit. I mean, it should recover. It shouldn't sell off for these reasons at all. I really think it's that subscriber thing that's got the street upset. The operating margins are up, so I don't think that's the core reason for why it's down. But that is a bit confusing to me, dude. That is a bit confusing to me. Not sure how that makes sense. Yeah, let's see in the chat. Do you guys own it? Do you own it? Let's see. Let me put this right here. I don't own Netflix. I've always thought that YouTube was the bear case for Netflix just because I think there's so much more content and there's so much more democratization of content, which is a little bit bad for Netflix because they don't have to spend on content. But I understand why people watch Netflix at the end of the day. Does anyone own Netflix? 168. Derek says, nope, it's sus. I agree, Derek. Very sus that they're not showing those numbers. Bought 630. Bought a call option for 630. Okay. I mean, I think I can get to 630. Is just that one sentence, dude, kind of messed it up. If they didn't have that one sentence and they just kind of were like, all right, we'll keep showing the numbers, maybe this thing would be up. I really think that's the number. Maybe there's something deeper in the financials I'm not looking at, but from a bird's eye view, I think investors are like, why am I going to hold on to this if I can't even get the transparency into seeing how many members they have? I do at 311. Okay. Amazing average. Eeyore was right, says this feels like the start of something very painful. So I would disagree with you if they didn't have that one sentence, because 5 million subscribers crushed. Paramount, they're getting bought out by some private equity firm. HBO Max, HBO Max is cool, but they're not at Netflix's number. Disney, no one gives a shit about Disney Plus. Like no one, like they're not a competitor in the streaming game. Hulu is fine, I get it, but they're still like Netflix is Netflix. But that sentence kind of feels like the start of something painful where they think, hey, we crushed on subscribers this quarter, but we don't know if we can do it again and again and again. And that's okay. But instead of being transparent and just saying, hey, look, we're not going to keep adding these many millions of subscribers, they're saying we're just not going to report our subscribers, which to me is, I don't want to say it's a red flag. It just feels weird, dude. Like, just be honest at the end of the day. You know, it just feels weird. Geo says it's 2.7% of your portfolio at 400. Okay, not bad. I mean, if you have below 500 average, I think that's a decent average, and you're up pretty well. You have a decent margin of safety. I don't think this thing tanks below 500. That would be. I think the S&P would have to take a nice little dump for that to happen. And we haven't had the 10% correction that we get every year, so maybe that 10% correction is coming. Who knows? But Netflix right now down 3% after hours. Thomas says, Amit, I think your explanation on overseas subscriptions helps a lot. As the company expands overseas to different subscription models, the number is hard to interpret, which is a good point. So here's the thing. If you're getting a ton of Indian subscribers, for example, that don't have the disposable income to spend something like an American subscriber would be spending on Netflix, which means the ARPU is lower. I still want to see how many people you're getting. I just think you need to have a different type of transparency and be honest with investors and say, hey, we are expanding to India and to, Indonesia and all these countries. They don't have $16 a month like Amit has to be able to pay. I mean, shit, even I barely have $16 a month to pay, right? So like they don't have Amit $16. But if we lock them in, we know we can keep them. The LTV eventually will be profitable. So we're gonna report our subscriber numbers, but don't be upset if we show that our revenue does not match the increase in subscribers, because the average revenue per subscriber is not going to be that high. If they just said that and said that we're expanding internationally more aggressively, I think as a Netflix shareholder, I wouldn't care about that. But the fact that they're not showing these numbers, it's weird, dude. It's really weird. Let's go back to CNBC and see their thoughts on this as well.
Yeah, John. So obviously, growth stocks have dominated this last upturn in the market, but I like a 3-year look of Russell 1000 growth versus value. Now, of course, growth's still outperforming, but it shows you how it got there, right? Ramping through 2021 into the ultimate peak in the market. Value holds its value a whole lot better than growth did in the bear market in 2022. And then growth kind of surges off the low. So it shows you that it's still where most of the market cap has been added on, but the cadence has been different. You kind of choose your temperament and your style within that. Now, one of the reasons that growth has still in this last several months been the leader is that it's really where the earnings momentum is. So this is from Barclays, and it shows the big tech, which is basically the old Magnificent Seven minus Tesla. And it shows the earnings revisions for the full year 2024. So how much earnings estimates have changed? Well, they've gone up a lot for those 6 stocks. And then you see what's gone for the rest of the S&P and the rest of technology outside of those 6, and it has been a modest decline. Now, that modest decline is really not a big deal. Over many months, the estimates often go down and then they're beat. But it does show you that there is a fundamental basis at this point for why you have had that mega cap growth dominance.
Okay, so stepping back for a moment, you were talking here on Overtime this week about the outsized reactions to earnings lately. And, you know, don't want to put too much on this initial reaction in Netflix. There's still the call to come. And of course, the trade in the regular trade tomorrow. But how high is the bar, you think, for growth stocks in this cycle, given what the market has done? S&P still above 5,000, and given what's happening with rates?
I think it's generally high for the likes of Meta, which have had these tremendous stock moves, haven't given much of it back, and they've really had their valuation surge. So I think for the leading mega caps, the bar is pretty high, at least psychologically. And I wouldn't necessarily say this Netflix move, at least not yet, is particularly erratic. It seems like 4 to 5%, given how much the stock is up, is kind of in the zone of what you might expect, Morgan.
Yeah, it's been pretty incredible to watch the fall in Tesla too, which closed today. Now it's market cap below $500 million.
Yeah.
Big move there, talking about the magnificent.
Oh boy. So, I mean, his point is that big tech is going to be hard to continue to rise. And look, that's not rocket science. They've done all really well year to date. I mean, let Netflix right now down 3%. Let's go through some of the stocks year to date. So Meta stock year to date, 45%, 44.9. Okay. So Meta has done very well. Amazon stock year to date is up 19%, basically 20%, 19.5. NVIDIA stock year to date is currently up, if I'm not wrong, I believe 70%. Let's just make sure. NVIDIA stock year to date is up 75%. So, I mean, these companies have done incredible. Netflix, before the drop, was up 30% year to date. Now it's down, and now it's up like 27%. But still, these companies have done amazing, and it's definitely going to be tougher for them to put up the numbers to continue to get momentum. Oh, hold on. I think the update should be out for the money markets. Let's see if it's out. Holy shit. Oh my. All right. What do you think, guys? Increase or decrease? What do you think? There was $6 trillion on the sidelines. What do you think? Increase or decrease? I just got the update. Oh my God. It's definitely, okay, it's extreme to the upside or the downside. I'll say that before you guys say it's extreme to the upside or the downside. It's not a couple billion here and there. It is a big number. What do you guys think, yo? What do you guys think? So over the past week, this is updated weekly. Over the past week, the Fed said we're not cutting rates anytime soon. Inflation's sticky as hell. And I mean, that's the big thing. Jerome Powell basically just said, hey, like things are gonna get bad, and the S&P fell below 500. Those are the two main things that happened. S&P fell, and Jerome Powell said we're not cutting rates anytime soon over the past 2 weeks. Increase. Okay, now put a number. Let's make this more fun. Put a number. 50 billion, 70 billion, 100 billion, 200 billion. I'll say it's above 20 billion. It's above 20 billion to the upside or the downside, but put a number. Clara says you're overexcited. I changed my vote to increase. I think I'm keeping a good poker face. I think you guys can't tell. I think you guys can't tell which one I like. Put a number and then put increase or decrease. So don't just put 30 billion or 40 billion. Put up or down as well, because I want to see if anyone gets it right, dude. I want to see if someone gets it right. So you have to put the number and the upside or the downside. Can I give away something? I'll give a $25 Amazon gift card to whoever gets this right. Oh, I already saw it. Someone got it right. Someone got it right. All right, make sure you're in the chat. Make sure you're in the chat. I got the person who got it right. Make sure you're in the chat. Don't leave, because I'm gonna and message me on Twitter right now. I'm putting my Twitter so I can send you the $25 Amazon gift card. Okay, make sure you DM me on Twitter. All right, here we go, folks. Money markets this week have increased to the upside by 112. Oh, sorry, decreased to the sorry. Yo, so many people must have been so happy just they decreased to the downside by 112 billion. Oh, Matt, I'm sorry. So Matt, I was going to click on your name because you said 100 billion up, but then even I read it wrong. So did anyone have 100 billion decrease? Did anyone have 100 billion decrease? Did anyone have 100 billion decrease? Everyone had 100 billion increase. Who was the closest? No one was close to this, dude. Dude, Matt, I was getting ready to highlight your comment because I thought you got it right, but I had dyslexia in that moment. I'm sorry, dude. I'm sorry. No, you can't put 100 billion down now, guys. I just said it. You can't put it down now. But anyway, $100 billion decrease. Dude, that's huge. That's fucking huge. Alex says he did that so he could keep the Amazon card. No, I actually had dyslexia in that moment, dude. I'm sorry. Did anyone even get close? Go up. I announced it at 4:31. At 4:30, if anyone had any comment that was close to the downside. See, the thing is, you guys were too bearish. Literally no one. I'm looking at all these comments. The closest we have is a 30 billion decrease. If you had put like 70 billion, 80 billion, I would send you the gift card, but that's too far away. That's too far away. Does anyone have it? I think Tom Brady. I think you get the gift card. I think that you had 65 billion decrease. I think you're the closest, Tom Brady. Make sure you message me on Twitter. I'll send it to you. I want to give it to somebody at least because I was gonna give it. I think you're the closest, dude. No one else had that much of a decrease. So Tom Brady, I know you have 7 championship rings, but make sure you DM me on Twitter and you got $25 Amazon gift card from me. Okay, there we go. So Tom Brady, don't forget. Make sure you DM me on Twitter and you'll get the gift card. I'm putting my Twitter again in the chat and I'll send it to you. I'll send it to you tonight. So money markets decreased by 112 billion. Now, this is really interesting. Last week, they also decreased by 30 billion. So we have had 140 billion of decreases in money markets. The stock market went down over the past week. So what I think theoretically has happened is money markets have come down, which means people took the cash and they were ready to put it in the market on Monday, Tuesday, Wednesday. And then Jay Powell on Monday basically said, hey, we're not cutting rates anytime soon. Yesterday, he had that conference with the Canadian Prime Minister saying, hey, inflation is really sticky, which means maybe that money was ready to go into the markets and then it didn't go because of what Jay Powell said. And next week, that money is going to go back into money market funds. Maybe that's going to happen. Maybe that's going to happen. Let's see. Maybe it went to gold. That's a good point. Maybe it went to gold. Maybe it did. You guys were too bearish, though. All of you guys said it was going to increase. You see, this is the problem. This is your guys' fault. The reason I thought Matt was going to win is because I kept seeing increase in the chat. And I was like, oh, he got it right because I saw the right number, 100 billion. But your bearishness made me think that Matt was right when in reality, nope. It was decrease. There we go. That's also a good point, dude. Taxes. You guys are right. Taxes, yeah. That's actually not bullish then. You guys are right. That money went to pay taxes. You're right. That didn't go into the markets. It was April 15th. It was tax week. Yeah, you're right. All right, Tom Brady, you're still going to get the gift card. I'll still give you the gift card because you were right. But you guys were right. That's not bullish. It was taxes. I'm trying to find some good news in this stupid Netflix report down 4%. I thought money markets were a sliver of good news. No, it was taxes. People have to pay their tax. Yeah, that's right. Now, 100 billion is a lot of money. 112 billion is a deal. But then again, we're talking about all of Americans paying taxes, corporations paying taxes. Yeah, it's probably taxes. That has nothing to do with the markets. You're right. All of you guys are right. So now it's your fault. Yes, it's your fault, Marcus. It's all of your guys' fault. All right, we got the Netflix call in 10 minutes. For those that are just joining, bullish for Uncle Sam. Yes, this is bullish for Uncle Sam. I was looking at some of the numbers. Apparently last year, let me pull this up. Apparently last year, we collected like 6 trillion. 4.9 trillion. Now 2022, it was like 6.2 or 2021, but then 2022 we had different tax cuts, so it was 4.9 trillion. So we collected 5 trillion, but we spent about 6.3 trillion. We had a deficit, and that deficit is continuing to add to the overall deficit of $34 trillion. So I mean, the amount of taxes are not going to be able to make up for the amount of spending, but it is obviously still, still pretty bad right now with what we have in terms of the national deficit. So yeah, money markets probably went to pay that off. Money markets went to probably pay that off. How much does the government get in taxes a year on average? I think it's close to 5 trillion pretty much every year. That seems like what it, I mean, from my understanding, it's close to that, especially over the past 10 years. The thing about the Trump tax cuts is that's what really started decreasing the revenue. Trump was up 25% today. Holy crap. Wow. Who was buying DJT? Yo, there's 1,000 people here. I'm sure one of you guys bought DJT. Someone here bought DJT. There's no way one of you guys did not ape into DJT. It's up 25%, dude. What the heck? Where's Palantir after hours? Robinhood 1706, S&P 499.49. Tesla 150. It's green. Palantir 2105, and then Netflix here down 3.4%. Amit, are you going to do a Bitcoin stream tomorrow? So the halving event kind of happens there's 200 blocks left until the halving, right? So yeah, we'll cover it tomorrow. I don't know exactly when it's going to happen, but we will be covering the halving event. I think it happens on 420, but maybe it happens tomorrow later in the night or 12 a.m. in the night. You guys can say if you bought. You don't have to be scared of saying if you bought. It's okay. It is what it is. I mean, if you bought it, you bought it. But I am curious to see. Now, the company that I think is actually buying is Susquehanna Group, and I think they'll have to disclose on their 13G. Remember, we talked about this on the channel. The owner of Susquehanna Group, which is a prop trading firm on Wall Street, owns a 30% stake in ByteDance, which is worth $21 billion. The guy has a net worth of $28 billion. So a majority of his net worth is in ByteDance, aka TikTok. Trump has said he won't let TikTok get banned. And the reason is because I think Jeffrey Yass is buying up a shit ton of shares in this stock, which is indirectly giving him money without literally giving him money, kind of bypassing campaigns finance law in the United States. It's actually a genius move. Ethical, I don't know, but it is a genius move to advance his political interests. And so I wouldn't be surprised if he's spending a couple $100 million to buy up this stock, prop it up. Trump can then dump the stock in 6 months. The guy would lose a couple $100 million, but that's nothing compared to losing $21 billion if TikTok gets banned in the United States. And I personally think, I don't even know if it's that much tinfoil hat. I genuinely think that might be the momentum. I don't think it's retail. 25% in a day, dude, is that retail? It is a short float. It is a short float. But I don't know if that would be just retail. Self Matterall says just lost 10,000 on Netflix. I am sorry about that. It's what happens when it comes to short-term options. I'm assuming you're doing options because your name is Options Trader. So it is what it is, dude. Hopefully it was 10K you can afford to lose, and you could have made 10K if it went to the upside. But it's not fully done. I mean, we still have the call. Maybe they say something on the call and this reverses. That usually doesn't happen on these earnings calls. They have to really say something good for the market to kind of reverse the direction. I mean, tomorrow this thing might dump in the morning as well, but maybe. Trust me, I know when a CEO says something on an earnings call, aka PayPal, for those that were there on that stream, and it doesn't go the right, it doesn't go the right way. So, oh boy, we got the call in 5 minutes, guys. We got the call in 5 minutes, and then we'll keep going with the stream. The Netflix beat or miss? Netflix beat. But for those that are joining, they have this new sentence in their earnings call that I think is the reason why it's down. Because I still have yet to find a reason. I don't know if anyone else has the reason for why the stock tanked outside of this lack of transparency. Starting in Q1 2025, we will stop reporting quarterly membership numbers. Are we being too harsh on them? Are they really getting too big where they don't need to report this anymore? Dude, to give you context, Facebook still reports their DAUs and their MAUs. Facebook has 4 billion fucking people using their shit. I feel like we deserve to know, if Facebook can report these numbers, I kind of think Netflix doesn't get a pass here. TSMC was in the morning. They did really good. Stock sold off because ASML had a bad earnings and all that, but it's nothing fundamental around TSMC. We talked about it on Chip Chat. I did a podcast earlier in the day, so you can watch that for more coverage on TSMC. That's Facebook not reporting those numbers, right? If Facebook says, hey, we're not going to report the DAUs anymore, I think the street would be like, oh, that's because no one's using your shit anymore, right? Or at least the street would be like, hey, maybe people don't use Facebook anymore. That's why you don't want to report it. And the street wouldn't be crazy to assume that. Any logical person could put 2 and 2 together and say, hey, maybe that's a logical reason why you don't want to report these numbers. But there we go. That's what you got. That's what you got on the numbers. Lisa said, nope, I bought me because I'm a crazy person. I love it. That's hilarious. That's hilarious. Looks like my thesis was playing out a bit. Earnings is key. If you don't crush it and have a killer outlook, you're going down. Yeah, I agree. But here's the thing. The Primordial Light, Netflix had a great earnings. They had a great earnings. These were good numbers. But I don't think they're expecting 15% growth, dude. That's not easy for a company of their size. So I'm still confused. Why are they down? The guidance is not bad at all. The operating margins are up 54%. Like I don't really understand how to make sense of it outside of the street's a little scared. Let's get Gene Munster. I think he's on CNBC right now and get his thoughts on what he thinks is going on. And then we'll keep going from there. We got the call in 3 minutes.
Says it's going to stop reporting quarterly subscriber numbers next year. Joining us now is Deepwater Asset Management Managing Partner Gene Munster and Third Bridge analyst Jamie Lunley. Welcome, guys. Gene, what does this change in sub-reporting mean?
It's an indication that the company recognizes that they've been through an impressive tailwind over the past 12 months. They've had, of course, the password, what's happened with the ads, also a price increase in November. So 2023 was packed with good news, good tailwinds. We're seeing that in the results now. They're thinking forward to next year, and I think understanding that they don't want to be held accountable to that metric. And I think that that is always a tell for investors in terms of when the pressure point on a stock, that metric is going to be less visibility. I think it is an indication that this is the scope, the trajectory of the story is going to change from these tailwinds to what are difficult comps and less visibility. So I put this clearly in the camp of looking forward, more of a negative than a positive.
Okay, so Jamie, what are the numbers that are going to matter more, relatively speaking, to investors now that they're not going to have that number, eventually to look at?
Well, certainly the subscriber numbers are the first metric that a lot of analysts have been looking at as one of the key areas where you can compare where these various streaming businesses and also understand the scale that Netflix has built. Going forward, there is, of course, the operating income and profitability, which are incredibly important and are, in addition to subscriber numbers, an area where Netflix is particularly differentiated. If we look at that margin over this past quarter, well above 20%, having them raise their operating guidance for this year. If we think about where the rest of the competitive landscape is, Disney is targeting long-term just double-digit operating margins in their streaming business, and Netflix is already well over that. So looking at that area, I think that's something they'll definitely want to focus on as they work on scaling their ad business, increasing revenue per user there. That's something they'll definitely be focusing on.
But the valuation of the stock itself, is it still compelling at these levels? Jamie?
I don't think so. I don't even think it's...
From my perspective, it's not. Where Netflix is today, they've come off an incredible past couple of months. Just looking at the idea of these comparable periods, Netflix has built a ton of momentum, and coming into this quarterly earnings report, the big question would be, are they going to be able to live up to some incredibly high expectations? And if we think about one way from here, there's still the ongoing crackdown on password sharing. There could be room left to run there. Netflix initially targeted 100 million households, which were sharing passwords. Even if we look at the numbers they've had today, there could still be a substantial opportunity to continue to scale. So if we think towards the future, if they do stop reporting those metrics, we could still be seeing the benefits of those growth numbers translating to both top line growth and ongoing expansion to the bottom line.
Along those lines, Gene, I mean, they do mention in this letter, quote, today our share of TV viewing is less than 10% in every country, so we have plenty of room to add value for our members and grow our share of viewing by broadening our slate, including live events, comedy, sports, competition shows, music. I mean, this has been a thing investors have been focused on as they have started to dip their toe into the sporting event world. How meaningful is that lever for them to pull?
Well, if it's kind of these one-off sporting events or kind of eclectic sporting events like wrestling, things like that, I don't think that that's going to, NASCAR, I don't think that that's going to move the needle. For them to really have growth drivers that can complement, that can add to what the drivers that they've had over the past year, for them to add to that, they got to get into some mainstream sports, and that's going to be an impact on margins. They talked about margins going down. They're typically conservative, so you need to take that into factor. But Morgan, I think that you have to look at this in the context of these growth drivers are going to come at a cost. And I think this is it's a solid business. It's not a business that should trade at after the downward revisions tomorrow at 40 times earnings.
Jamie, I know it's a bit early for this, but journey with me, if you will, into the broader media industry now. What's the impact on everybody else who's been trying to chase Netflix using subscriber numbers sort of as a proxy and been losing money doing it? What's the impact on them of Netflix eventually not reporting those sub numbers?
All right, I think the call is starting. Yeah, here we go. The call's here. Here we go. We're live.
We've evolved, and we're going to continue to evolve, developing our revenue model and adding things like advertising and our extra member feature, things that aren't, directly connected to a number of members. We've also evolved our pricing and plans with multiple tiers, different price points across different countries. I think those price points are going to become increasingly different. So, each incremental member has a different business impact. And all of that means that historical simple math that we all did, number of members times the monthly price, is increasingly less accurate in capturing the state of the business. So this change is really motivated by wanting to focus on what we see are the key metrics that we think matter most to the business. So we're going to report and guide on revenue, on OI margin, net income, EPS, free cash flow. We'll add a new annual guidance on a revenue range to give you a little bit more of a long-term view. We'll also, we're not going to be silent on members as well. We'll periodically update when we grow and we hit certain major milestones. We'll announce those. It's just not going to be part of our regular reporting. And we want to do all of this thoughtfully and give everyone time to adjust this transition. So we're going to continue to report subscribers until Q1 of next year, which links into our next annual revenue guidance for 2025. So we think that provides some long-range continuity, and we expect that'll provide an effective bridge and transition. But ultimately, we think this is a better approach that reflects the evolution of the business, and it more matches and is consistent with how we manage internally to engagement, revenue, and profit.
Yeah, and on engagement, Greg, just a reminder, we currently report our engagement on our biannual engagement report, leading the industry in viewing transparency and granularity. And we're going to look into building on that both in granularity, which would be kind of tough. Our current report covers about 99% of the viewing on Netflix, but we'll look at the regularity in different ways that we can make it even easier to track our progress on engagement. And but importantly, why we focus on engagement is because we believe it's the single best indicator of member satisfaction with our offering. And it is a leading indicator for retention and acquisition over time. So happy members watch more, they stick around longer, they tell friends, which all grows engagement, revenue, and profit, our North Stars. And we believe that those are the measurements of success in streaming.
Great, thank you, Ted and Greg. I'll move us along to the next question from Ben Swinburne of Morgan Stanley, who asked, 2 years ago, Netflix stopped adding members. What changes inside Netflix and or the broader industry explain the significant improvement in member growth we're seeing today, excluding the paid sharing initiative? In other words, what are you doing better today as a company than in the first half of 2022?
That's a great question. I would say the thing we're doing is we're thrilling our members. That's the thing we set out to talk about, why we all bounce out of bed in the morning. Look at this last quarter. 8 of the first 11 weeks of the year, we've had the #1 film on streaming. 9 of the first 11 weeks, we've had the #1 original series. And I'm talking about hits like Avatar, The Last Airbender, Griselda, Damsel, Love is Blind, Three Body Problem, all of that just in the last few months. So this consistent and dependable and expected drumbeat of hit shows, films, and games, that's the business that we're in. And that's what we have to do every day. And we have to do it all over the world. So if you think about that and how we're doing about kind of quality at scale in multiple cultures and multiple regions, I look at this last quarter, you see Fool Me Once, One Day, Gentlemen, Scoop, the super buzzy Baby Reindeer, all that from the UK, all in the last few months. Berlin, Society of the Snow, Alpha Males, all from Spain and all just in the last few months. So that's been, one of those things that we just keep building and building and building on. And local unscripted, which is a fairly new initiative for us. And we're finding huge success with things like our second season of Physical 100 in Korea recently and Love is Blind Sweden. These are all kind of hard to replicate things that we keep getting better and better at every day, that we're really proud of the teams for doing that. So, and remember, engagement captures all of this, and none of that's possible without great tech and product. We need to do both.
Yeah, I think that's right. I mean, the fundamental is all those amazing series, film, games, live events. But a key component of our success, and something that we're seeking to get constantly better at, is that ability to find audiences for all those great titles. Part of making that happen is just the number of people who look to us for entertainment. We mentioned over 500 million people in this letter. But part of that is that product we do to effectively connect those folks with titles that they will love, which then enables us to find, the largest audiences for those titles that we think that they could get anywhere. And I think as you mentioned, Ted, this applies globally to titles from all over the world, which is super exciting. So, and then of course we seek to maximize the fandom and the impact on the conversation and the cultural zeitgeist that all those titles have. And when we do that well, that just feeds positively into that cycle as we launch new titles. So, in terms of what are we doing better? What do we do better? We seek to get better at all of those things. And if we can make that whole flywheel spin a little bit faster, then that's great for our members, it's great for our titles, and it's great for our creators.
Thank you, Ted and Greg. Moving us along, we have Barton Crockett from Rosenblatt. There's a question about our revenue guidance. I will direct this question to Spence. Spence, can you please explain what drives the revenue deceleration for the full year? So 13 to 15% revenue growth for the full year, compared with the 15 to 16% growth in the first and second quarters of this year. Secondly, he also has a question about second quarter subscriber growth. Will that be higher or lower than Q2 of 2023?
All right, sure. Well, thanks for the question. So first, regarding revenue growth overall, full year outlook, I feel really good about where we are in our growth outlook. So I just want to be clear about that. We've done a lot of hard work over the past 18 months or so to reaccelerate the business and reaccelerate revenue through a combination of improving our core service, which Greg and Ted just talked about, and rolling out paid sharing, launching our ads business, and that reacceleration really started in the back half of 23, and it built through the year. So our growth in the back half of 24 is really kind of comping off of those harder comps. And at the high end of our revenue forecast, our growth in the second half is consistent with our growth in the first half, even with those tougher comps. And, it's still early in the year. We still got a lot to execute against. We also, as you see in our letter, there's been some FX that with the strengthening dollar, that's a bit of a headwind. So we'll see where that goes throughout the year. But, we're guiding a healthy double-digit revenue growth for the full year, which is what we set out to deliver. And that's what's reflected in the range. And, I guess maybe it's in the question, I guess, seated in this is a little bit of like what's really kind of the outlook for our growth of the business, not just the back half of this year, but into 25. And it's too early to provide real specific guidance, but we're going to work hard to sustain healthy double-digit revenue growth for our business. And we really like the kind of the opportunity ahead of us. We're so small in every aspect. We're only 6% roughly of our revenue opportunity. We're less than 10% of TV share in every country in which we operate. There's still hundreds of millions of homes that are not Netflix members, and we're just getting started on advertising. So the key is to, as you just heard from Greg and Ted, continually improve our service, drive more engagement, more member value. As we do that, we'll have more members. We'll be able to occasionally price in that value, and also have a big, highly engaged audience for our advertisers. So more to come on 25 guidance, but we feel good about the outlook. And then I guess the second part of the question, I'm trying to remember, Spencer.
I'll be the bad guy on this one, Spencer. The second question was, do you expect Q2 subscriber growth to be higher or lower than Q2 of the prior year? So Barton, as you know, we don't give formal subscriber guidance. We did give an indication in the letter for you that we expect fairly typical seasonality. So paid net ads in Q2 of this year will be lower than Q1 of this year. And that's the limit of the color we'll provide there.
Thanks,
no problem, Spence. So to follow up on the revenue guidance question, we have Jason Helfstein from Oppenheimer, who's asking for some more color on the drivers of the full year revenue guidance. with respect to subscriber growth versus ARM growth and how those two dynamics will play into the revenue forecast, Spence.
Yeah, you want me to take this one as well?
Yep.
Okay, I'll jump in. Others can chime in as well. But when you think about the outlook for the year, it's in terms of the mix of revenue growth, it's kind of pretty similar to we expect it'll be pretty similar to what you see in Q1, where it's primarily driven by member growth because of the kind of the full year impact of paid sharing rolling through the year. And continued strong acquisition and retention trends. But we are seeing some ARM growth as well. We saw it in Q1, about 1% on a reported basis, 4% FX neutral. And I just want to be clear, what's happening is that with ARM is price changes are going well. And that's why we're seeing those strong acquisition retention trends, because it's testament to the strength of our slate, the overall improvement in the value of our service. But we've only really changed prices in a few big markets, and that was US, UK, France late last year, and only on some of the plan tiers in those markets, not even all the plan tiers. And since then, it's been mostly pretty small countries, other than Argentina. And in Argentina, as you can see, we're sort of pricing into the local currency devaluation, and you see that in the difference between FX neutral and reported growth in Q1. So mostly what you're seeing in our growth profile this year is the fact that we haven't taken pricing in most countries for the past 2 years, really. And we also have some ARM kind of headwinds in the near term that you see in Q1. You'll probably see throughout most of this year, which is that, one, we have this planned mix shift as we roll out paid sharing. So while it's highly revenue accretive, as you can see in our numbers and our reported growth, strong reported growth in Q1 and outlook for the year, that growth, as we spin off into new paid memberships, they tend to spin off into a mix of plan tiers that's a little bit of a lower price skew than what we see in our tenured members. And we're also growing our ads tier at a nice clip, as you've seen, I'm sure we'll talk about. And monetization is lagging growth there. I'm sure we'll talk about that a bit as well. We also have some country mix shifts. So that whole combination of factors results in pretty modest ARM growth, still some ARM growth, but pretty modest in Q1 and probably throughout the year. But again, the key there is that, this is all, we're kind of managing this business transition in a way that's really healthy for overall revenue growth, as you see with 15% reported revenue growth in the quarter, strong outlook for the year. And we're building into a much more kind of durable and healthy foundation for revenue growth going forward across a larger base of paid members, and a really kind of strong and scaled, highly engaged audience for it to build into our advertising over time, and a strong paid sharing solution, and also to kind of penetrate into those households. So we'll increasingly kind of see that mix in our revenue growth, and we start to see some of it this year.
Great. Spence, the next question comes from Kannan Venkateshwar from Barclays, and it's for you, which is, do you expect margin growth trajectory to continue being on the present path for a few years? Can you attain margins that are comparable to legacy media margins?
Well, thanks, Kannan. And our focus is on sustaining healthy revenue growth and growing margins each year. That's what we talk about a lot. We also talk about in the letter. And we feel good about what we've been delivering. 21% margins last year, that's up from 18% in the year before. And now we're targeting 25% this year, which is up a tick from the start of the year when we were guiding to 24%. So I'd say, just like we have in the past, we'll take a disciplined approach to balancing margin improvement with investing into our growth. We've managed that balance historically pretty well, growing content investment, growing profit margin, and growing cash flow. You should expect we'll continue to do that, but the amount of annual margin expansion in any given year could bounce around a bit with FX and other investment opportunities. But again, we're committed to grow margin each year, and we see a lot of runway to continue to grow profit and profit margin over the long term.
Thank you, Spence. Our next question comes from Alan Gould of Loop Capital. Which inning are we in with respect to enforcing paid sharing? 2 years ago, you said 100 million subscribers were sharing passwords with 30 million in UCAN. How many do you estimate still borrow passwords? And I'll turn the floor over to Greg to answer that question.
Yeah, as we mentioned last quarter, we're at the point where we've operationalized the paid sharing work. So this is just now part of that standard mechanism that we've been building and iterating on over time to translate more entertainment value and great film series, games, live events into revenue. And like we do with all of the significant parts of our product experience, we're iterating on that, testing it, improving it continually. So rather than thinking beyond, specific cohorts or specific numbers, we really think about this more as developing more mechanisms, more effective ways to convert folks who are interacting with us, whether they be borrowers or folks that were members before that are coming back. We call them rejoiners, or folks that have never been a Netflix member. So we want to find the right call to action, the right offer, the right nudge at the right time to get them to convert. And just to be clear, we still see opportunities to improve this process. We got line of sight on several improvements to this value translation mechanism that we expect will deliver and contribute to business growth for the next several quarters to come. But I also very much believe that just like for the last 15 years, we've always found something to improve in this process, and even beyond those, for years and decades to come, we'll be working on this and making it better and better and better. So all of those improvements should allow us to effectively get more of that 500 million plus smart TV households to sign up and become members. Spence mentioned the hundreds of millions yet to come. This is a way to effectively get at more of those folks and make them part of our membership base. And as we mentioned earlier on the call too, I think worth noting that while we're fully anticipating continuing to grow subs, the overall business growth now has extra levers and extra drivers like plan optimization, including things like extra members, ads revenue, pricing into more value, which is important. So those levers are also an increasingly important part of our growth model as well.
Great. I'll move us on now to a series of questions around advertising. The first of which comes from Doug Anmuth of JP Morgan. What are the most important drivers of scaling your ad tier when you think about adjustments you could make to pricing and plans, partner bundles, and marketing? How do you get people over the hump for that a few minutes of ads an hour can still be a very good experience at the right price? Greg, why don't you take that one?
Yeah, all the things mentioned in the question matter. And I would say we're generally taking our entire playbook, everything that we've learned about how do you grow members, and we're applying it to our ads tier now. So clearly that means partner channels, it means device integrations, bundles, integrated payments. Those are all important tools for growth, just as they are and will continue to be in our non-ads offering. Increasing awareness of the quality of our ads experience, especially relative to the linear TV ads experience, which in many countries is really quite poor. That's an important and iterative tool. When we talk about sort of marketing and awareness building, that's going to be part of our growth mechanism. Low price, that's important to consumers. $6.99 is an example in the United States for multiple streams, full HD downloads. We think that's a great entertainment value, especially at the industry-leading low ad load that we've got. So that's critical as well. So I think you can see the results of leveraging all of these mechanisms and more, and how our ads tier has been scaling over the last couple of quarters. So we're 65% up quarter to quarter this last quarter. That's after 2 quarters of about 70% quarter over quarter growth. For me, it's exciting to see that growth rate stay high, even as we've grown the base so much, because obviously the numbers indicate that means that there's more absolute additions each quarter. So we're making good progress there. But look, we've got much, much more to do in terms of scaling. We've got more to do in terms of effective go-to-market, more technical features, more ads products. There's, plenty of work ahead for us on ads.
Great, Greg. Our next question on advertising comes from Rich Greenfield of Lightshed. He has a 3-part question. Part 1, can you update us on your thinking around the optimal spread between the ad tier and the ad-free tier? Secondly, is your advertising ARPU, excluding the subscription fee, up meaningfully versus your original comments that it was in the $8 to $9 range last year? And then lastly, can you give us a sense of what ARPU would look like if supply was not outstripping demand?
Okay, I'll take the first one and then maybe hand the ARPU/ARM points to Spence. We don't have a fixed a priori position on sort of the optimal pricing spread. And much like we've done with price changes in general, we really use signals from our customers, things like plan take rate, conversion rates, churn, to guide us along an iterative path to get to that right pricing. And I think it's also probably worth noting that sort of right pricing is not really a static position. As we continue to evolve and improve our offering, that's going to change as well. But I think a good general guideline for us in the long term is that it would be healthy for us to land overall monetization between our ads and non-ads offerings in roughly an equivalent position. So that really comes down to, what works best for any given member. And it's really a member choice about which plan they think serves them the best. And then I'll hand it over to Spence on ARM questions.
Sure. No, thanks, Greg. So in terms of ARM and your question, Rich, in terms of how we're doing now relative to what we discussed when we first launched the business, and, as Greg said, we've been growing our inventory at quite a fast clip. And so monetization hasn't fully kept up with that growth and scale and inventory, as we're still early in building out our sales capabilities and our ad products. But that is an opportunity for us because we're still a very premium content environment, a very highly engaged audience that's at an increasing scale. So our CPMs remain strong, and we're building out our capabilities, as Greg talked about. So the revenue is going to follow engagement over time, and it's already kind of growing nicely, which is great, just off a small base. So then really, as Greg said, what that means for ARM is right now it is a bit of a drag on our ARM because of we're kind of under monetizing relative to supply. But over time, we expect to be similar in revenue on our ads tier, a combination of subscription as well as ads revenue with those kind of non-ads offerings. So that's how to think about it, but we're building to it over time.
Great. Last question on advertising comes from John Hoodlick at UBS. How are you approaching this year's upfronts, and do you believe the base of ad-supported users is now of the scale that upfront commitments can drive a meaningful change in advertising revenue and be a contributor to ARM growth in 2025? So perhaps, Ted, maybe you could start, and then Greg follow after that.
Yeah, of course. Look, first and foremost, this is our second upfronts. We're really excited to go and share with advertisers this incredible slate that we're very, very proud of. So they're going to get a look at some of the shows that are upcoming right away, like brand new seasons of Bridgerton and Sweet Tooth and The 90s Show. Some of our big unscripted events upcoming, like our Tom Brady roast, by way of example, and brand new shows like Dead Boy Detectives and Shane Gillis's new show Tires, Eric, a great new limited series out of the UK with Benedict Cumberbatch that we're super excited about. And then they'll even get a longer look at what's coming up in the second half of the year, which is, again, returning seasons of Cobra Kai, Emily in Paris, The Night Agent, Outer Banks, and Squid Game, our big one. And a brand new season of Monsters from Ryan Murphy, which is the Lyle and Eric Menendez story this year, which is going to be really incredible thing to share with our advertisers. A brand new original series and limited series like American Primeval from Pete Berg, Heartburn with an all-star cast, Nicole Kidman and Liev Schreiber, Senna, which is this great limited series on the great Brazilian Formula One driver. That we're really excited about. And also I look at our movies coming up that we'll end the year with like Eddie Murphy in his most iconic role, Axel Foley, in Beverly Hills Cop Axel Foley. Carry On, a big new animated feature, Spellbound. So we've got a lot of entertainment in store for the audience at the upfronts.
Yeah, I think this is an opportunity to re-engage with advertisers and look at the fundamentals of what our offering is. I mean, first and foremost, it's an incredible list of titles that brands want to be connected with. It's just super exciting to hear that roster. We've got great engagement from our members on our ads tier. We've got an opportunity to grow that even further. We think that's connected again to the power of those titles. We're rapidly growing scale, as we mentioned. That's the number one request we've had from advertisers, so that's exciting. We're making progress on technical features like measurement, on ads products, so we're excited to get that out there. And really, this is just an opportunity to bring all of that progress in a package to advertisers. And of course, to get input from them, because we know that they're going to have comments and they're going to have things that they're going to want us to continue to work on. And then really just to continue that journey, because we know there's plenty more to go do to realize the potential we have in this space. And so I would say, we're continuing to grow here. We're growing off of a relatively small base in terms of the impact against an already big and substantial business. So even though it's growing quite quickly, it takes a while to grow that into the point where it's material. So we look forward to that increasing in 25 and then, increasing further 26 and beyond.
Great. I'll now transition us to several questions around content. And this first one I'll direct to Ted. It's a rare question around why don't we spend more? Given what seems like a very favorable current backdrop for Netflix to acquire and license content, why not lean in even more aggressively? Could it make sense to spend more than $17 billion in cash content this year?
Yeah, independent of the availability of licensed content, you should look at it. I think we've always been very disciplined about the way we invest in the business and how we grow it. And we can get a lot of bang for our buck by spending our money well and producing our shows really well, and also by acquiring the right content. And the floodgates have opened a little more on licensing for sure. But again, we're very focused on the ones that we think will drive the business. So I think we're at our current level of spending and our current level rate of growth, and we're pretty comfortable spending just behind that anticipated rate of growth.
And Ted, Jason Helfstein's follow-up is also about licensed content or second-run content. And his question is, how would more second-run licensing impact your margins and free cash flow?
Well, the budget is the budget, so it's all part of how we spend against the content. And the free cash flow economics, we've gotten pretty close in our cash flow against P&L on our content spend generally. So I don't think it would have very much impact on that. Unless you want to add some color to that, Spence.
I just love you talking about the discipline on our content budgets, Ted. It makes me happy. No, I agree with all of it. I mean, we spend into the opportunity, but with, I think, prudent constraints and discipline. And to be clear, like there, as you say, there has been more licensed content opportunity, but the vast majority of our content spend is still into original programming. It is and is likely to continue to be. So we'll always complement it with great licensed content for that variety and quality for our members. But the original content is still our future too.
Yeah. Great. Next question is from Michael Morris of Guggenheim. Specific about the Jake Paul-Mike Tyson fight. For Ted, what are the characteristics of the upcoming Jake Paul-Mike Tyson fight that make this the type of sports programming you're interested in investing in? How does that content benefit your member base and advertising growth goals?
So we're in the very early days of developing our live programming. And I would look at this as an expansion of the types of content we offer, the way we expanded to film and unscripted and animation and most recently games. On-demand and streaming have been unbelievable for consumer choice and control. And it's really put the controls of television back in the hands of consumers, which has been really phenomenal. But there's also something incredibly magic about folks gathering around the TV together in the living room to watch something all at the same time. We believe that these kind of eventized cultural moments, like the Jake Paul and Mike Tyson fight, are just that kind of television that we want to be part of winning over those moments with our members as well. So that for me is the excitement part of this. We have beyond the fight itself, we have several nights of live comedy coming from the Netflix is a Joke Festival next month. And starting in January, we've got 52 weeks of live sports with WWE Raw. That's going to be coming to our members every week on Netflix. And we think it's going to be a real value add to watch those things in real time. And we're going to continue to try a lot of new things. But the core of it is do our members love it? And judging from the early excitement around the Jake Paul-Mike Tyson fight, there's going to be a lot of people waking up in the middle of the night all over the world to watch this fight in real time.
I think worth noting that, just as what's relevant to members in terms of these, large cultural events that Ted talks about, that's what has relevance to advertisers as well. So it's an opportunity for us to expand our advertising offering and give those brands access to these kind of culture defining moments.
Thanks, Ted and Greg. And I'm personally looking forward to that event, and my money is on Iron Mike Tyson. But as a follow-up on the sports...
Bold.
Yes, he still got it, I think. But as a follow-up to the sports question for Ted, as you continue to scale Netflix and become bigger and bigger and potentially gain more leverage, how could your sports strategy change beyond what you're doing today around primarily sports entertainment?
Yeah, we've said this many times, but not anti-sports, but pro-profitable growth, and I think that's the core of everything we do in all kinds of programming, including sports. So, our North Star is to grow engagement, revenue, and profit, and if we find opportunities we could drive all three of those, we will do that across an increasingly wide variety of quality entertainment. So when and if those opportunities arrive, that we can come in and do that, which we feel like we did in our deal with WWE. If we can repeat those dynamics in other things, including sports, we'll look at them for sure. So I think we've had the benefit of building an enormous business without a loss leader, and we continue to believe that we can grow on that path, just as you've seen. So I think the core of it is that we're going to look at those opportunities with the same discipline that we do when we talk to movie producers and television networks about putting our content on the air.
Great. The next question comes from Rich Greenfield from Lightshed about our film strategy. So for Ted, a recent New York Times article cited internal communications from new Netflix film chief Dan Lin stating, quote, "The aim is to make Netflix's movies better, cheaper, and less frequent. Lin wants his team to become more aggressive producers, developing their own material rather than waiting for projects from producers and agents to come to them," unquote. Everyone wants to make better, cheaper films, but we find it hard to believe, we being rich, find it hard to believe that there is a magic formula. Help us understand the strategy shift under Dan Lin versus Scott Stuber.
Well, thanks for that question, Rich. I would send you back to that New York Times article because that was not a quote from Dan. And I would say that, and nor did we participate in that article. I would say, just to be clear, there is no appetite to make fewer films. But there is an unlimited appetite to make better films always, even though we have made and we are making great films. We want to make them better, of course. We're super excited to have Dan join the company. He just joined a couple of weeks ago, and he's joined us running 100 miles an hour. Bella has said this publicly, that our strategy remains variety and quality. And she's doing an amazing job of bringing new, fresh thinking to our content and our content organization. Bringing Dan on board is a great example of that. We want to have a lot of movies. We want them to thrill our audiences, and they all have different tastes, and we want them all to be great. So we take a very audience-centric view of what quality is. And Dan knows that from having produced for us. As the CEO of Rideback, he produced the Oscar-nominated film, The Two Popes, for us. He did Avatar: The Last Airbender for us recently. So he understands Netflix and the audience really, really well. And his success in live action and animation is very hard to define in the business. So we're thrilled he's doing it here.
Great. Thank you, Ted. The next question comes from Kanan Venkateshwar from Barclays. Could you please provide an update on engagement trends now that paid sharing is mostly behind you? So I'll kick it over to Ted first, and Greg, you can feel free to add on.
Well, look, it's important to note that we compete for every hour of viewing all the time, every day, everywhere we operate. And we think that engagement report is very important, and that metric's important because, again, it's the best indicator of customer satisfaction. I know I just said this 10 minutes ago, but I'm going to repeat it. 8 of the first 11 weeks of this year, we've had the #1 movie, and 9 of the last 11 weeks of this year, we've had the #1 series. And that's according to the Nielsen streaming data. And for us, that is what we're singularly focused on. And we've actually seen in that Nielsen data our share tick up a little bit, even in this incredibly competitive space where you've got a lot of folks competing for attention, for time, and for money.
Yeah, Ted, I think you can repeat that 8 of 11, 9 of 11 as many times as you want, as far as I'm concerned.
I'm going to close with it too.
So, as we have said, due to the work that we've been doing on password sharing, we're essentially cutting off some viewers who are not payers, and therefore we're going to lose some viewing associated with that. So when you see our next engagement report, you are going to see some impact to our overall absolute view hours as a result of that. But despite that impact, and despite the general pressure from strong competition that Ted noted, we think our engagement remains healthy. You can see it in the stat that Ted indicated in terms of the Nielsen ratings and our modest growth in TV time in the United States. But we also wanted to do an apples to apples view of engagement. So we looked at the population non-impacted by paid sharing, what we called owner households. And in Q1 of 24, the hours viewed per account were steady with the year ago quarter. So that's a pretty good sign that our engagement's holding up, and it sort of cuts through the noise around paid sharing. And again, I just want to reiterate, we think we got plenty of room to grow engagement, right? We're still less than 10% of TV hours, even in our most mature markets. So there's tons of room of growth ahead of us.
Thank you, Ted and Greg. I'm going to move us along now to a series of questions around plans and pricing strategy. So from Steve K. Hall from Wells Fargo, Greg, as you continue to expand, do you think there is a ceiling for pricing? If so, how close are we to that ceiling in mature markets? And do you envision Netflix having content tiers so that you can continue to expand your content genres and further segment your customer base?
Yeah, we don't have a set position on a ceiling. I mean, sure, you can look at pay TV as a potential markers for, where people have spent before, but we really actually don't think of it so much is defined by that. We see it as an opportunity to continue the process that we've been working on, which is let's, continue to try and invest wisely, add more entertainment value. And as we add more entertainment value, then of course we can go back to our subscribers and ask them to pay a little bit more to keep that virtuous cycle moving. And really the markers for us in terms of the upside potential more are around, the hours on TV that we are winning, how many moments of truth we call it that we are winning. Again, less than 10% in our even most mature markets. There's tons of room there. You can use total consumer spend on entertainment in the markets and categories that we compete in. That's, between 5 and 6%. So there's just a lot of runway still ahead of us to go do a good job at making that investment happen, deliver more value, and then, ask folks to pay a little bit more.
Great. Next question on pricing comes from Mark Shmulik of Bernstein. Can you please share progress on how the retirement of the basic plan is going in the UK and Canada? And is there any color you can share on when we could expect a similar rollout in the US? Greg, why don't you take that one?
Yep. As we shared in the Q4 23 letter, we were planning on retiring our basic plan in some of our ads countries. We've now started that process in Canada and the UK, and very similar to what you saw us do with paid sharing. We're going to work hard to make this a smooth transition. Part of that is listening to our members before we make any further moves. So we've got nothing, more to announce, and we really want to see how this goes. Yeah, and we know that this is a change for our basic members, but we think we've got a strong offering for them. They're going to get, more for less, 2 streams versus 1. We've got higher definition. We've got downloads, all at a lower price. And of course, it goes without saying, hopefully that members can always choose our ads free plans as well if they prefer.
Great. Thank you, Greg. Couple questions on overall capital allocation. So these would be for Spence, primarily from John Blackledge of TD Cowen. Excuse me. You mentioned evolving capital allocation strategy in your investor letter with your new investment grade status. Can you please talk about changes in how investors will see that change?
Yeah, sure. Thanks for the question. It's really quite a modest evolution of our capital allocation strategy to better reflect our investment grade status, and that's really what it is. It's we're still going to have the same financial policies and principles in terms of prioritizing profitable growth by reinvesting in our core business, maintaining a healthy balance sheet with ample liquidity, and returning excess cash beyond several $billion on the balance sheet of minimum cash and anything that we use for selective M&A to return to shareholders through share repurchase. So really the only change is that now that we're solidly investment grade, we're going to, while we will hold still several $billion of cash on the balance sheet, we won't have the same marker of 2 months of revenue, the equivalent of 2 months of revenue on the balance sheet. So it allows us to be a bit more efficient there. We also upsized our revolver, which was announced today, up to $3 billion from $1 billion, which also gives us more access to capital and better cash efficiency. And then again, any cash beyond that will return to shareholders. We've historically been mostly a build versus buy company with select strategic kind of acceleration through M&A, and that there's nothing right now planned, but that still is kind of our philosophy, is to build predominantly. We're also going to kind of refinance our existing kind of debt as those maturities approach. But we don't plan to kind of lever up through stock buyback. We really do value that balance sheet flexibility.
Great. Thank you, Spence. Last question on capital allocation for you. This comes from Vikram of Baird. What are your latest thoughts on the appropriate level of content spend for the business beyond 2024? Specifically, in the past, you have referenced a 1.1 cash content spend to amortization ratio. Is that still the case? And what would you need to see in an opportunity to meaningfully exceed that framework?
Yeah, it still holds. It still holds. So we're still basically, the short of it is we're really kind of managing to that. So as we said, we've been focused on driving that acceleration of our revenue growth, continuing to grow our business, grow our profitability. As we do that, we would expect to continue to grow our content investment as we have historically into the highest impact areas, but also be quite disciplined there. So we want to grow our free cash flow. So we believe we can manage to that roughly 1.1x of cash content spend relative to expense on the P&L, and that leads to overall revenue growth, increased profit margins, growing free cash flow, and it still gives us a lot of opportunity to spend into the all those kind of content and entertainment categories that Greg and Ted have been talking about.
Thanks, Spence. We have a few more minutes left, so we'll wrap up with a few higher level questions. The next one comes from Eric Sheridan of Goldman Sachs. And I think both Ted and Greg can tackle this one. The question is, what are your thoughts on the competitive impact from short form video consumption?
So I look at what people watch, and when they watch it have a lot to do with one another. What are the choices and how much time do they have? So our version of short form is more like giving our members the ability to watch 10 minutes of an episode of a series that they're binging right now if they only have 10 minutes. But and also when I look at the short form viewing on YouTube and TikTok, some of it is adjacent and quite complementary to our viewing. So our trailers or creators expressing their fandom for our shows, like posting a Wednesday dance or ugly crying, watching One Day, all those kind of things that become viral sensations and actually increase the fandom of our shows. Now, that being said, some of that viewing is directly competitive with us, the same as it is with other media companies who provide content to YouTube by way of example. The art of this has always been finding the right balance of both. And also would point out that these platforms have been a way to have new voices emerge, and we've got our eye on them as well to try to develop them into the next generation of great storytellers on Netflix.
Great.
All right, that's it for Netflix. Let's analyze it a little bit, see how the stock's doing, and then I will get you guys out of here. Thank you all for joining. I like Netflix, the company. I like the co-CEOs. I think they're good guys. I think they answer the questions in an honest way. I love that they did this video thing, even though it looked like they were in a sauna. I do not like this decision they made. However, as you can see right here, the stock's down 5% right now of not reporting subscriber numbers. I just don't like it. I just tweeted about it over the past 20 minutes. And so if you're following on Twitter, you can see some of the commentary going there. But I'm pretty much getting the same response from what you guys are saying in the chat, which is that this is just weird. Now, obviously, the argument is that Netflix cannot continue to grow as much as they're doing right now, and or the subscriptions they're getting are not as profitable because they're international. So it doesn't make sense to report those subscriber numbers. In my opinion, if Meta is reporting their 4 billion DAUs, if Tesla is reporting their deliveries, I mean, just imagine if you were a shareholder in Tesla and they said, yeah, we're just going to report our gross margins and our revenue, but we're not going to report our deliveries because the deliveries are slowing down or because they think they don't need to. Like, you would just be like confused, right? You would be like, I'm a shareholder in this company. You have a fiduciary duty to give me the information I need to make a well-informed decision. And objectively speaking, I think it's well-informed, or the metric that quantifies well-informed is how many subscribers do you have? Now, the comparison to Apple that some people have been making, which is that Apple doesn't need to report literally how many iPads they sell. Apple at this point is a $2.5 trillion company, a little bit bigger than Netflix at $250 billion, which is now not going to be $250 billion in the morning when the market opens. But also, Apple is way more diversified in terms of the products that they're providing to have the burden to literally track every single one, right? AirPods, watches, Vision Pros, MacBooks, the different versions of the MacBooks, all that stuff. Netflix has one thing they're selling: a subscription. That's it. It's not that complicated, dude. It's like it should be very simple to be able to report that number. I think the reason they're doing it is because they don't think they're going to grow that number top line anymore, which is fine. But I think you have to tell investors that, or pay a dividend, or do something else to get investors to be on board. But you cannot have it both ways. This is the one thing I hate that public companies try to do. It is not your money. It is the public's money. It is our money. I'm not an investor in Netflix, but if I was, it is my money that is facilitating the capital expenditures for you guys to operate as a business. If you don't tell me certain things about the business, I might have to take my money out of that business. And so in the context of Netflix, they can't say, oh, well, you should definitely keep buying our stock because we're going to deliver all this growth. And then when it comes to the primary metrics to describe that growth, you say, well, we're not going to disclose these. We're going to disclose the other ones. But don't worry, because even in the earnings call, they said periodically, the guy was smiling. He was like, oh, but don't worry. Like periodically, it's not like we're going to turn a blind eye. We're going to definitely, show the subscriber numbers. What is more periodic than 4 times a year? Literally every 90 days is pretty periodic, in my opinion, right? Like it's pretty periodic at the end of it. Like 90 days, 4 times a year, it's not asking for that much. So to me, that's a periodic update. Does that mean they're only going to do it once a year, twice a year? And if you're still going to do it twice a year, you can't do it another 2 times. If you're only going to do it once a year, it's at the end of the year, right? Like, so we have to wait till December just to get an update. It doesn't make any sense to me. This decision makes 0 sense to me. And by the way, if Facebook stopped reporting their DAUs, it would be annoying. But at this point, Facebook is so big, 4 billion people. Netflix has 270 million households. Facebook has 4 billion. Like, I could understand why Zucks is like, look, guys, we really don't need to report this anymore. Like, we're too big. We're not going to grow anymore. We have the whole fucking world on our platform. Netflix does not have the whole world using Netflix. There is a lot of room to grow, and I'm sure Netflix would agree that there's a lot of room to grow. If there's a lot of room to grow, then you got to show the growth. You got to show the growth. It's a public company, dude. You got to show the growth when it comes to this. Just doesn't make sense to me. AutoP says they moved their stats matrix to Trust Me Bro. Basically, they moved their stats and how they report their stats to Trust Me Bro, because that's the other thing. They said we're gonna report our operating income and our top line revenue, but we're not going to report subscribers. Well, I'm like, well, if your revenue is growing by XYZ, your operating income is improving by XYZ, then is it that hard to just show how many subscribers are also part of that? Do we really have to do the math? Because Loop Capital and Goldman Sachs and JP Morgan and Morgan Stanley and Bank of America, they're all going to figure it out. It's not like you're going to hide it from them forever, dude. These guys spend millions and millions of dollars on research. They're going to figure it out. They're going to do some complicated math. You're just making it harder for them to figure out. And by the way, they're not going to buy the stock if the number is bad. So to me, I think Netflix needed to be more mature here. I think this was a bad decision. I don't think the business is diversified enough to be able to definitively say they don't need to make this decision. As soon as we started the earnings call, the first thing they said is that, we're focused on engagement, which is why we're not focused on subscriber numbers. Engagement comes from subscribe. Like you only grow engagement if you're growing the overall pie. I mean, yes, if a user is watching a lot more Netflix, that tells me that Netflix is good, but that user is not that much more profitable at the end of the day, unless you raise prices, which over time, sure, but you're not going to raise prices every single year. So that one user watching a ton of Netflix, great. I love those stats. But how many more people are getting introduced to the platform at the end of the day? The market hates uncertainty, correct? The market hates uncertainty. And so if the market hates uncertainty, it's a bit harder to see kind of how that plays out. Oh, thank you for this comment right here, ES. EXT is next to the auto button at the bottom of Webull chart. Toggle it to see the movements. I actually never knew that. Oh, there you go. So this is after hours. Oh, wow. Huh. I never knew that. EXT stands for extended hours. Thank you for that. That's great. Okay, so before earnings season, this is really good. I've never clicked on this little button after hours. So now every earnings that we cover on the channel, we will literally see the candle to the upside or the downside. That's great. That's awesome. Thank you for that. Thank you for not hiding that information the way that Netflix is hiding their subscriber numbers. So that's what you got right now on Netflix. As you can see right here, stock's down 583. I think this sells off tomorrow, guys. I don't know the macro is not the best, and the stupid decision to not report the numbers. Revenue was a beat. Subscribers, they beat by 4 million. Overall was a great earnings. Operating incomes increased 54%. But I don't think this stat was good enough. Now, could it, and tomorrow's a Friday. Friday, market tends to sell off. Could people buy the dip? Maybe. But what are you buying the dip for? Are you buying the dip for a company you're not going to get more information about a year from now when they stop reporting the numbers? I mean, come on now. That's a little bit too much. That's a little bit too much. Ty Gordon has been trying to tell him for months, dude, you never had a comment as easy as ES had. You never had a comment as easy as ES had. ES's comment was just easier. ES's comment was easier. No one told me that. Yes, no one told me that. You guys never told me that. You can have extended hours combined with a day chart. ES is saying now scroll out to see more chart screen. Okay, so just zooming out a little bit, or can we do? Oh, okay, we can kind of do it like that as well. Okay, gotcha. All right, so we hit a low of 578 at about 10 minutes ago, 525, and right now here we're at 585 after hours. So those are my thoughts on Netflix. At the end of the day, I think this was not a good move on the company, and I think they might be punished for it tomorrow. Now, granted, I wouldn't be surprised if someone buys the dip. Like, it's not, down 5% on these numbers is probably stupid, but that transparency thing about not reporting, I do think that's going to be a big deal. And I think the market's going to get upset. And it's not just me. What I'm looking at on Twitter, a lot of people also agree that this is not a good move. And they're at least sussed out, to say the least, about the lack of the subscriber numbers. Let's look at the rest of the market. S&P 499.34 after hours. Palantir 2105. Robinhood 1708 after hours, basically flat. And DJT is up after hours. It was up 25% today. It's up 0.02% after hours. Tesla back down 149.26. Wow, Tesla selling off after hours. Tesla rebounded from 149 during the day to like 151. Now back here to 149. Cam, they're not reporting new subscriber numbers. That's what they're not reporting. Starting in Q1 2025. That's what they're not going to be reporting. Netflix had a PE of 51. Oh, wow. I didn't know that. Actually, yeah, no, I think you're right. Netflix had a PE of, yeah, you're right. That definitely doesn't help. If you have a PE that high, and literally their PE is 51. Tomorrow it's going to take a little bit of a haircut. Your PE is 51 and you're growing, but you're going to stop showing us the transparency on the only metric that really matters for your growth, which is subscribers. That can definitely get you a little hit. And you're up 30% year to date. That's dude, if they did not have that one sentence, I think the stock might be down, but it wouldn't be down 5%. I really do. I think the street would have been like, all right, Netflix is growing 15% year over year. Paramount sucks. Disney Plus sucks. Hulu sucks. Disney, or not Disney, Warner Brothers sucks. The HBO Max sucks. They're the only profitable ones that can grow. 15 million subs. Like, let's buy the stock. But then they said, hey, we're probably not going to keep growing as much because we're not going to report these numbers. And I think the street got upset. So that's what we got right now for Netflix. Nordstrom's just announced it's looking to go private. Oh boy, where's their stock? Nordstrom, JWN. It's up 2% after hours. JWN, Nordstrom. Why is Nordstrom trying to go private? Nordstrom. This is like the women's department store chain going private. Yeah, right. Oh, that was an hour ago. Wall Street Journal reported Nordstrom family weighs taking retailer private. Interesting. I wonder what their valuation would be if they take it private. That means they would pay off all the public shareholders for going private. Yeah, I think that's pretty much it. Let's look at SMCI. There was a report that SMCI might announce something after hours. SMCI is flat. I mean, they're down 0.73%, so nothing too crazy. We'll keep an eye on that in the morning tomorrow if SMCI says anything interesting. I heard a little bit that they might be doing something. And S&P 499.28 right now. All right, that's it for me. Thank you guys. We'll be live on Finance Junkies breaking down the Fed. Oh, by the way, Kashkari, the Fed president, he just came out and he said we're probably not going to cut rates till 2025. At this point, I think these guys are, he said that after hours. I think these guys are saying it to like to propel a hawkish narrative. Like I genuinely think they're doing it at this point to like get the market to cool down because the market's been so hot, but I don't think they mean it. I do think they're concerned about inflation being sticky. I get that, but I don't think this 2025 rate cut narrative, they're actually believing that. I think they're just saying it because they don't want the market to rip. Maybe. We'll see. We'll see tomorrow. And then, yeah, so we'll have Finance Junkies tonight. We'll talk about the Fed and what happened today with inflation. We have some housing data we want to talk about. And then we'll talk about Netflix as well on the earnings call on Finance Junkies tonight. All right, that's it for me. Thank you, everybody. Please make sure you follow on Twitter. I'll put the Twitter in the chat, and we'll keep going from there. Tomorrow morning, we'll be live on the Market Open, recovering. So literally covering, again, the Netflix earnings, and we'll go from there. And then the Bitcoin halving. The Bitcoin halving happens tomorrow, right? The Bitcoin halving happens tomorrow. There's 200 blocks left to be halved for the Bitcoin halving event. I believe it's going to happen in like 24 hours. Hold on. Bitcoin, there's a website that shows Bitcoin halving countdown. 1 day and 3 hours. Yeah. So around April 20th, that is the expected time. 25 hours. Yep. So we got another day left. All right. We'll be covering it. Let's see what happens. Thank you, everybody, for being here. I'll see you guys on Finance Junkies and then tomorrow on the Market Open. Have a good one. Bye, everyone. Thank you.